time. So we intend to be very responsive.
And we're going to take you live now back to the Senate hearing. Chairman Bernanke entering the room.
And Ms. White and Block without opening statements. I will enter my full statement for the record. Senator Crapo, do you have anything to add?
No, Mr. Chairman, I'll enter my statement for the record as well.
We will now vote to report the nominations of Dr. Jason Furman to be a member and chairman of the Council of Economic Advisors, Ms. Cara Stein to be a member of the SEC, Dr. Miracle Pivovar to be a member of the SEC, the Honorable Richard Metzger to be a member of the NCUA Board, and the Honorable Mary Jo White for a second term as a member of the SEC, expiring on June 5, 2009. Those in favor, say aye. 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 Those opposed, say nay. Ayes have it. The nominations are hereby reported favorably to the full Senate. We will now consider Congressman Watt's nomination to head the FHFA. Congressman Watt has over 40 years of experience in housing, real estate, and other financial service issues as an attorney and member of the House Financial Services Committee. In his 20-plus years practicing law, he has personally walked hundreds of families through real estate closings. This is the kind of in-depth expertise we need leading the FHFA. So I urge my colleagues to join me in voting for Congressman Watt's nomination. Senator Crapo, would you like to make a brief statement?
Yes, Mr. Chairman, thank you. And I'm pleased that we were able to move the initial group of nominees by a voice vote today. I congratulate each of them and wish them a speedy confirmation process on the floor. Representative Watt has had a long, distinguished career in the House of Representatives and in legal practice. He's well liked by his colleagues, regardless of whether they see eye to eye with him on the issues. His personal story is compelling at every level, and I believe he could have easily won confirmation with broad bipartisan support for a number of cabinet and presidential advisor positions open at the time of his nomination. However, this position is like no other position in our government. As conservator, this nominee would actually operate Fannie Mae and Freddie Mac, whose combined portfolios exceed $5 trillion. In fact, if confirmed, this nominee would stand alone as regulator, operator, and shareholder of Fannie Mae and Freddie Mac. Because the conservator has virtually unchecked power to control two multi-trillion-dollar companies, and through them our entire mortgage market, the conservator must be an apolitical financial regulator with technical expertise and someone who will resist political pressure from all sides of the political spectrum. Additionally, the conservator must possess an in-depth knowledge of the operations of the mortgage industry, the mortgage-backed security industry, structured securitizations, investment portfolios, the operations of both public and private insurance and guarantees, and the expertise to oversee the nearly 12,000 employees employed by both entities. The White House was fully aware of all of these concerns. However, rather than acknowledging the unique aspects of the job, the White House chose to ignore these calls that they emphasize technical expertise and political independence in their search. I'm disappointed with that decision and forcing us today into the position we find ourselves. As I evaluate the unique powers and responsibilities of the conservator, I cannot support Representative Watt to fill that position and must also urge my colleagues to oppose his nomination. Thank you, Mr. Chairman.
Would any other members like to make a brief statement? We will now have a roll call vote on Congressman Watt to be a director of the FHFA. The clerk will call the roll.
Mr. Chairman?
Aye.
Mr. Reed?
Aye.
Mr. Schumer?
Aye.
Mr. Menendez?
Aye.
Mr. Brown? Aye. Mr. Tester?
Aye per proxy.
Mr. Warner? Aye. Mr. Merkley?
Aye per proxy.
Ms. Kagan? Aye. Mr. Manchin?
Aye per proxy.
Ms. Warren? Aye. Mrs. Hyken? Aye. Mr.
No.
Mr. Shelby?
No by proxy.
Mr. Corker? No. Mr. Vitter?
No by proxy.
Mr. Johanns?
No by proxy.
Mr. Toomey?
No.
Mr. Kirk?
No by proxy.
Mr. Moran?
No by proxy.
Mr. Coburn?
No.
Mr. Heller?
No by proxy.
The vote is 12 in favor, 10 opposed. The nomination is approved.
The ayes have it. The nominations are hereby reported favorably to the full Senate.
Mr. Chairman.
Senator Brown.
Thank you, Mr. Chairman. I would like to just take 30 seconds to address the nomination of Mary Jo White. I voted against Ms. White in March. At the time, I said I hope she proves me wrong. Unfortunately, at this point, I view her record as more negative than positive. She's not yet met the burden of proof to change my mind. For that reason, my position has not changed, but I hope that it will. Thanks, Mr.
Any member has 7 days to enter a statement into the record, but before we turn to our hearing, would anyone else like to make a brief statement on any of the nominations? The executive session is concluded, and we will proceed to our scheduled monetary policy hearing. Yeah. Thank you. Good morning. I call this hearing to order. Today we welcome Chairman Bernanke back to the committee to deliver the Federal Reserve's semi-annual monetary policy report. Nearly 5 years after the worst financial crisis since the Great Depression, the U.S. economy continues to show signs of improvement. Recently, we have seen the housing market strengthen and payroll employment firm up. Private sector job growth strengthened this year to around 200,000 jobs per month. The economy has shown signs of resilience despite fiscal tightening. On housing, I'm pleased to see that the recovery is gaining momentum with solid home price gains nationwide. New home construction has seen double-digit growth, and single-family home sales have also picked up. Many homeowners remain underwater, but overall numbers continue to decline. Going forward, I would encourage the Fed to be thoughtful in its actions to make sure these positive trends in housing continue. Congress has a role to play too. To address FHA's short-term challenges, Ranking Member Crapo and I released details this week of bipartisan legislation to get FHA back on stable footing and strengthen a program important to many Americans. Following this effort, we will turn to comprehensive housing finance reform legislation. Much progress has been made, but the labor market has not fully recovered from the Great Recession. Labor force participation remains low even when accounting for retiring baby boomers, and long-term unemployment remains near historic levels. Moreover, youth unemployment remains high, and even many young college graduates struggle to find gainful employment. These trends have lasting effects on the economy. Over the longer term, still erosion from prolonged unemployment would reduce our economy's potential. It is important that we help, not hurt, young Americans' prospects, and why it is so important that Congress finds a reasonable solution to the recent increase in student loan rates. To fulfill its dual mandate, the Fed should not prematurely step on the brakes. With consumer price inflation low and the unemployment rate unacceptably high, the Fed must continue to take action to support employment. When the time comes, it is important that monetary policy adjustments are gradual and do not disrupt financial stability and economic growth. Chairman Bernanke, I thank you for your years of service and leadership at the Federal Reserve during a challenging period in our nation's history, and I look forward to hearing your testimony. I now turn to Ranking Member Kripel.
Thank you very much, Mr. Chairman. And Chairman Bernanke, welcome. I welcome our Federal Reserve Chairman, Ben Bernanke, back to the Banking Committee to testify at the semi-annual Humphrey Hawkins hearing regarding the Federal Reserve's monetary policy and the state of the economy. In recent weeks, the prudential banking regulators have been very active on a number of regulatory fronts, including releasing final regulations to implement the Basel III capital rules and proposed regulations on capital leverage ratios. I thank Chairman Bernanke personally for addressing the concerns that Chairman Johnson and I raised in our February letter about the unique characteristics of community banks and insurance companies. A one-size-fits-all approach regarding capital rules does not work for these types of entities. With regard to monetary policy, we've experienced a period where the Fed has pushed the short-term interest rate down to zero more than 4 years ago. The Fed pursued quantitative easing, or what's become known as QE, in order to suppress long-term interest rates. As a result, the Fed's balance sheet now stands at nearly $3.5 trillion, with an additional $85 billion every month in long-term assets being added. Recently released FOMC minutes from the June meeting indicate that several members of the board felt that a reduction in asset purchases would likely soon be warranted. Several noted economists have called into question whether the benefits of these purchases outweigh the risks. The negative reaction by equity markets to the June FOMC statement on tapering indicates that some of the increase in the prices of equities and other assets recently is attributable to the Fed's balance sheet expansion and not to purely economic fundamentals. In fact, June marked the worst month on record for bond fund outflows. The reaction indicates that markets are still heavily reliant on government intervention, which is not good for the long-term health of the economy. I'm interested to hear from Chairman Bernanke to what extent the Fed anticipates the inevitable tapering process will cause in terms of additional periods of market volatility. Because of the official stance of the Fed is that the decision to taper remains data dependent, I'm interested in hearing if the Chairman believes laying out specific data would improve both the Fed's commitment to the policy and the market's reaction to it. Beyond tapering, which is simply slowing the rate of growth of the Fed's balance sheet, is the more important issue of winding down the Fed's massive balance sheet. The Fed has indicated that it may continue to roll over its holdings of long-term assets, which means that its balance sheet may not shrink for some time. A key element of the exit strategy adopted by the FOMC in June of 2011 is a 3 to 5 year period over which the Fed expected that it could completely eliminate its holdings of agency securities. This was done for the purpose of minimizing the extent to which the agency securities portfolio might affect the allocation of credit across sectors of the economy. Since then, the balance sheet has increased in size by more than 20% to, as I said, almost $3.5 trillion. And the Fed's holding of agency securities has increased by more than 30% to about $1.2 trillion. Why does the Fed see the need for such accommodative policy to continue into the future? In light of the Fed's large portfolio increases, the dominant role that the GSEs play in today's mortgage market, and the recent increases in the level and volatility of mortgage rates, will the Fed revise its balance sheet exit strategy principles? In particular, will the Fed be revising the time period over which it expects to eliminate its holdings of agency securities? It's my hope that this hearing gives us additional insight into the Fed's plans for the future reduction of asset purchases and a roadmap for a return to normalized, rules-based monetary policy. Thank you, Mr. Chairman.
Thank you, Senator Crapo. To preserve time for questions, opening statements will be limited to the chair and ranking member. I would like to remind my colleagues that the record will be open for the next 7 days for additional statements and other materials. I'd like to welcome Chairman Bernanke. Dr. Bernanke is currently serving a second term as chairman of the Board of Governors of the Federal Reserve System. His first term began under President Bush in 2006. Before that, Dr. Bernanke was chairman of the Council of Economic Advisors and served as a member of the Board of Governors of the Federal Reserve System. Chairman Bernanke, please begin your testimony.
Thank you, Mr. Chairman, Ranking Member Crapo, and other members of the committee. I'm pleased to present the Federal Reserve Semi-Annual Monetary Policy Report to the Congress. In my brief remarks, I'll discuss current economic conditions and the outlook, and then turn to monetary policy, and I'll finish with a short summary of our ongoing work on regulatory reform. With respect to the outlook, the economic recovery has continued at a moderate pace in recent quarters, despite the strong headwinds created by federal fiscal policy. Housing has contributed significantly to recent gains in economic activity. Home sales, house prices, and residential construction have moved up over the past year, supported by low mortgage rates and improved confidence in both the housing market and the economy. Rising housing construction and home sales are adding to job growth, and substantial increases in home prices are bolstering household finances and consumer spending while reducing the number of homeowners with underwater mortgages. Housing activity and prices seem likely to continue to recover, notwithstanding the recent increases in mortgage rates, but it will be important to monitor developments in this sector carefully. Conditions in the labor market are improving gradually. The unemployment rate stood at 7.6% in June, about a half percentage point lower than in the months before the Federal Open Market Committee initiated its current asset purchase program in September. Non-farm payroll employment has increased by an average of about 200,000 jobs per month so far this year. Despite these gains, the job situation is far from satisfactory, as the unemployment rate remains well above its longer-run normal level, and rates of underemployment and long-term unemployment are still much too high. Meanwhile, consumer price inflation has been running below the committee's longer-run objective of 2%. The price index for personal consumption expenditures rose only 1% over the year ending in May. This softness reflects in part some factors that are likely to be transitory. Moreover, measures of longer-term inflation expectations have generally remained stable, which should help move inflation back up toward 2%. However, the committee is certainly aware that very low inflation poses risks to economic performance, for example, by raising the real cost of capital investment, and increases the risk of outright deflation. Consequently, we will monitor this situation closely as well, and we will act as needed to ensure that inflation moves back toward our 2% objective over time. At the June FOMC meeting, my colleagues and I projected that economic growth would pick up in coming quarters, resulting in gradual progress towards the levels of unemployment and inflation consistent with the Federal Reserve's statutory mandate to foster maximum employment and price stability. Specifically, most participants saw real GDP growth beginning to step up during the second half of this year, eventually reaching a pace between 2.9 and 3.6% in 2015. They projected the unemployment rate to decline to between 5.8 and 6.2% by the final quarter of 2015, and they saw inflation gradually increasing toward the committee's 2% objective. The pickup in economic growth projected by most committee participants partly reflects their view that federal fiscal policy will exert somewhat less drag over time as the effects of the tax increases and the spending sequestration diminish. The committee also believes that risks to the economy have diminished since the fall, reflecting some easing of financial stresses in Europe, the gains in housing and labor markets that I mentioned earlier, the better budgetary positions of state and local governments, and stronger household and business balance sheets. That said, the risks remain that tight federal fiscal policy will restrain economic growth over the next few quarters by more than we currently expect, or that the debate concerning other fiscal policy issues, such as the status of the debt ceiling, will evolve in a way that could hamper recovery. More generally, with the recovery still proceeding at only a moderate pace, the economy remains vulnerable to unanticipated shocks, including the possibility that global economic growth may be slower than currently anticipated. With unemployment still high and declining only gradually, and with inflation running below the committee's longer-run objective, a highly accommodative monetary policy will remain appropriate for the foreseeable future. In normal circumstances, the committee's basic tool for providing monetary accommodation is its target for the federal funds rate. However, the target range for the federal funds rate has been close to zero since late 2008 and cannot be reduced meaningfully further. Instead, we are providing additional policy accommodation through two distinct yet complementary policy tools. The first tool is expanding the Federal Reserve's portfolio of longer-term Treasury securities and agency mortgage-backed securities. We are currently purchasing $40 billion per month in agency MBS and $45 billion per month in Treasuries. The second tool is forward guidance about the committee's plans for setting the federal funds rate target over the medium term. Within our overall policy framework, we think of these tools as having somewhat different roles. We are using asset purchases and the resulting expansion of the Federal Reserve's balance sheet primarily to increase the near-term momentum of the economy, with a specific goal of achieving a substantial improvement in the outlook for the labor market in a context of price stability. We've made some progress toward this goal, and with inflation subdued, we intend to continue our purchases until a substantial improvement in the labor market outlook has been realized. In addition, even after purchases end, the Federal Reserve will be holding its stock of Treasury and agency securities off the market and reinvesting the proceeds from maturing securities, which will continue to put downward pressure on longer-term interest rates, support mortgage markets, and help to make broader financial conditions more accommodative. We are relying on near-zero short-term interest rates, together with our forward guidance that rates will continue to be exceptionally low. This is our second tool, to help maintain a high degree of monetary accommodation for an extended period after asset purchases end, even as the economic recovery strengthens and unemployment declines towards more normal levels. In appropriate combination, these two tools can provide the high level of policy accommodation needed to promote a stronger economic recovery with price stability. In the interest of transparency, committee participants agreed in June that it would be helpful to lay out more details about our thinking regarding the asset purchase program, specifically to provide additional information on our assessment of progress to date, as well as of the likely trajectory of the program if the economy evolves as projected. This agreement to provide additional information did not reflect a change in policy. The committee's decisions regarding the asset purchase program and the overall stance of monetary policy depend on our assessment of the economic outlook and of the cumulative progress toward our objectives. Of course, economic forecasts must be revised when new information arrives, and thus are necessarily provisional. As I noted, the economic outcomes that the committee participants saw as most likely in their June projections involved continuing gains in labor markets, supported by moderate growth that picks up over the next several quarters as the restraint from fiscal policy diminishes. Committee participants also saw inflation moving back toward our 2% objective over time. If the incoming data were to be broadly consistent with these projections, we anticipated that it would be appropriate to begin to moderate the monthly pace of purchases later this year. And if the subsequent data continued to confirm this pattern of ongoing economic improvement and normalizing inflation, we expected to continue to reduce the pace of purchases in measured steps through the first half of next year, ending them around mid-year. At that point, if the economy had evolved along the lines we anticipated, the recovery would have gained further momentum, unemployment would be in the vicinity of 7%, and inflation would be moving toward our 2% objective. Such outcomes would be fully consistent with the goals of the asset purchase program that we established in September. I emphasize that because our asset purchases depend on economic and financial developments, they are by no means on a preset course. On the one hand, if economic conditions were to improve faster than expected and inflation appeared to be rising decisively back toward our objective, the pace of asset purchases could be reduced somewhat more quickly. On the other hand, if the outlook for employment were to become relatively less favorable, if inflation did not appear to be moving back toward 2%, or if financial conditions, which have tightened recently, were judged to be insufficiently accommodative to allow us to attain our mandated objectives, the current pace of purchases could be maintained for longer. Indeed, if needed, the committee would be prepared to employ all of its tools, including an increase in the pace of purchases for a time, to promote a return to maximum employment in the context of price stability. As I noted, the second tool the committee is using to support the recovery is forward guidance regarding the path of the federal funds rate. The committee has said it intends to maintain a high degree of monetary accommodation for a considerable time after the asset purchase program ends and the economic recovery strengthens. In particular, the committee anticipates that its current exceptionally low target range for the federal funds rate will be appropriate at least as long as the unemployment rate remains above 6.5% and inflation expectations remain well behaved in the sense described in the FOMC statement. As I've observed on several occasions, the phrase "at least as long as" is a key component of the policy rate guidance. These words indicate that the specific numbers for unemployment and inflation in the guidance are thresholds, not triggers. Reaching one of the thresholds would not automatically result in an increase in the federal funds rate target. Rather, it would lead the committee to consider whether the outlook for the labor market, inflation, and the broader economy justified such an increase. For example, if a substantial part of the reductions in measured unemployment were judged to reflect cyclical declines in labor force participation rather than gains in employment, the committee would be unlikely to view a decline in unemployment to 6.5% as a sufficient reason to raise its target for the federal funds rate. Likewise, the committee would be unlikely to raise the funds rate if inflation remained persistently below our longer-run objective. Moreover, so long as the economy remains short of maximum employment, inflation remains near our longer-run objective, and inflation expectations remain well anchored, increases in the target for the federal funds rate, once they begin, are likely to be gradual. Let me finish by providing you with a brief update on progress on reforms to reduce the systemic risk at our largest financial firms. As Governor Tarullo discussed in his testimony last week before this committee, the Federal Reserve, with the other federal banking agencies, adopted a final rule earlier this month to implement the Basel III capital reforms. The final rule increases the quantity and quality of required regulatory capital by establishing a new minimum common equity Tier 1 capital ratio and implementing a capital conservation buffer. The rule also contains a supplementary leverage ratio and a countercyclical capital buffer that apply only to large and internationally active banking organizations consistent with their systemic importance. In addition, the Federal Reserve will propose capital surcharges on firms that pose the greatest systemic risk and will issue a proposal to implement the Basel III quantitative liquidity requirements as they are phased in over the next few years. The Federal Reserve is considering further measures to strengthen the capital positions of large internationally active banks, including the proposed rule issued last week that would increase the required leverage ratios for such firms. The Fed also is working to finalize the enhanced prudential standards set out in Sections 165 and 166 of the Dodd-Frank Act. Among these standards, rules relating to stress testing and resolution planning already are in place, and we have been actively engaged in stress tests and reviewing the first wave resolution plans. In coordination with other agencies, we've made significant progress on the key substantive issues relating to the Volcker Rule and are hoping to complete it by year-end. Finally, the Federal Reserve is preparing to regulate and supervise systemically important non-bank financial firms. Last week, the Financial Stability Oversight Council designated 2 non-bank financial firms. It has proposed the designation of a third firm, which has requested a hearing before the Council. We are developing a supervisory and regulatory framework that can be tailored to each firm's business mix, risk profile, and systemic footprint, consistent with the Collins Amendment and other legal requirements under the Dodd-Frank Act. Thank you. I'd be pleased to take your questions.
Thank you, Chairman Bernanke. As we begin questions, I will ask the clerk to put 5 minutes on the clock for each member. Chairman Bernanke, with inflation low and unemployment still high, what trends in the data would you need to see before deciding to begin unwinding monetary policy measures? Would unwinding too early threaten the economy and the financial system?
Well, certainly we face the same issues that are always faced when monetary policy begins to normalize after a period of recession and expansion, which is if we tighten too soon, we risk not letting the economy get back to full employment. If we tighten too late, we risk having some inflation. So, as always, there are going to be issues of judgment there that are unavoidable in any monetary policy normalization. That being said, we have laid out essentially a three-stage process for our normalization. The first, which is dependent on the economy strengthening, the labor market continuing to normalize, and inflation beginning to move back towards 2%, is a process of slowing, moderating the pace of our asset purchases and eventually bringing those to zero additional purchases at the point that we can say that we've made substantial improvement in the outlook for the labor market. And we've given some guidelines about how that process would go forward. The second stage would be a potentially lengthy period in which we are watching the economy for continued improvement, continued reduction in unemployment, normalization of inflation. As I described in my testimony, when unemployment gets to 6.5% and not before, and when inflation is looking closer to target, at that point, we would consider whether tightening in the form of raising short-term interest rates is appropriate. So that would be the second stage. The final stage would be the ultimate normalization of policy, the raising of short-term interest rates, and eventually the normalization of our balance sheet. As I noted in my testimony, assuming that the economy remains in a slow growth mode, as we've been seeing, that process will be a very gradual process.
What explains the recent rise in long-term interest rates, and how much more of an increase in rates could cause a recovery to falter, and what would the Federal Reserve do to respond if interest rates spike?
Well, there are essentially three reasons why we've seen some increase in longer-term rates, although I would emphasize they remain relatively low. The first is that there's been some better economic news. As investors see brighter prospects ahead, interest rates tend to rise. For example, we saw a relatively good labor market report, which was accompanied by a pretty sharp increase in interest rates on that day. A second reason for the increase in rates is probably the unwinding of leveraged and perhaps excessively risky positions in the market. It's probably a good thing to have that happen, although the tightening that's associated with that is unwelcome. But at least the benefit of it is that some concerns about building financial risks are mitigated in that way and probably make some FOMC participants more comfortable with using this tool going forward. The third reason for the increase in rates has to do with Federal Reserve communications and market interpretations of Fed policy. We've tried to be very clear from the beginning, and I've reiterated again today, that we have not changed policy. We are not talking about tightening monetary policy. Merely, we've been trying to lay out the same sequence which I just described to you about how we're going to move going forward and how that will be tied to the economy. But I want to emphasize that none of that implies that monetary policy will be tighter at any time within the foreseeable future.
What do you currently see as the biggest threat to the housing market recovery as we continue housing finance reform?
Well, certainly we have to keep our eye open to pay attention to mortgage rates and affordability. That's our job at the Fed. But I think it's very important for us to get our housing institutions, our regulatory structure, to get those cleared up, to get those in working order. I'm glad to see that the Congress is now looking at reforms of the Fannie and Freddie, the mortgage securitization system. We still have rules to do about skin in the game and other aspects of the mortgage market. I think as there's greater clarity about the rules of the game for mortgage making and mortgage securitization, that we will see less tightness in the market for mortgages for first-time home buyers and people with less than perfect credit scores. And I think one of the risks that we face now is that there is still a pretty significant part of the population that is having considerable difficulty accessing mortgage credit, even though they may have the financial wherewithal to be worthy of that credit.
Senator Kripel.
Thank you, Mr. Chairman. And Chairman Bernanke, you've previously indicated that the Fed wants to see substantial improvement in the labor market before cutting off QE. And in your June press conference, you noted that substantial is in the eye of the beholder. If I understood you today, you indicated that if all goes as expected, we could expect to see this wound down completely by mid-year next year. Is that correct?
If all goes as expected, yes.
And I guess the flip side of that is you said if all does not go as expected, we could see QE continue for the indefinite future.
I suspect that at some point that the economy will reach that substantial improvement in the outlook, given the way we've seen progress to this point. Exactly whether it's a little bit later or a little bit earlier, that remains to be seen.
I guess my question is, I assume you would agree that there is risk in continuing QE indefinitely. Would you agree with that?
Yes, there are costs and risks to QE, and we're watching those carefully. We've said in our statement that one of the considerations that we're looking at every meeting is the efficiency and costs of this program, and we do a benefit cost analysis as we discuss the benefits and of additional purchases.
Well, given the notion that substantial is really in the eye of the beholder, I don't think it's very easy for the markets to understand exactly how and when we are going to see the winding down occur. And to me, it appears that possibly communicating more specific targets rather than thresholds would help to reduce that risk. Do you agree, or do you think it's just not possible to get more specific?
Well, this is an issue that the committee will continue to discuss. I would say first that we have given some fairly specific qualitative guidance about what we're looking for, and I did say that unemployment in the general vicinity of 7%, with inflation moving back towards this 2% objective, was indicative of the kind of progress that we were trying to achieve. The thresholds are tied to rate increases, and there, while reaching that threshold doesn't necessarily mean that we'll raise rates, we are quite confident that we will not raise rates before we get to those points. In that sense, we're providing a reassurance to the public and to the markets.
Thank you. And with regard to winding down the Fed's balance sheet, you and others have indicated a willingness to keep the Fed's QE securities on the balance sheet, rolling over maturing securities and keeping them out of the market. Governor Tarullo said on Monday that no one is talking about unwinding or selling the securities we've been buying, which would mean then that the Fed's balance sheet could be over $3 trillion for some time. Correct?
Well, not necessarily, because of course these ultimately we will stop rolling over and reinvesting the securities, and then they'll begin to run off, and then the balance sheet will start to come down. We have done a lot of scenario analysis, of course, and allowing the securities to run off at a certain point when the economy is strong enough does not delay normalization by very much.
But you're not expecting the winding down of the balance sheet at any time soon. Is that correct?
Certainly not until we get to the rate increase part of the three-part sequence that I described to you, and there again it would be not. We are not planning at this point to sell any MBS. What we would be doing would be allowing, at some point, we would be allowing the maturing securities just to run off and not replacing them.
But as long as you continue to hold and not wind down the balance sheet, doesn't this lead to credit mispricing and increased investor risk undertaking?
I don't think so, particularly when we're winding down. I don't see that there's any real difference between, for example, our holding mortgage-backed securities, which is intended to strengthen the housing market, and usual monetary policy, which lowers long-term interest rates through short-term rate cuts, which is also intended to strengthen the housing market. The housing market is always an important channel of monetary policy, and so I don't really see that there's any significant misallocation going on there.
All right, thank you.
Senator Menendez.
Thank you, Mr. Chairman. Chairman Bernanke, I understand this may be your final monetary policy report hearing before the committee before the end of your term as chairman of the Federal Reserve, and I'm sure you'll miss us. But I want to thank you for your hard work and dedication and your service to our country, especially during a time of crisis, and I appreciate your service. We seem to be experiencing a trend right now where our economy and employment are growing and recovering, but we still have, from my perspective, a ways to dig ourselves out from the deep hole caused by the financial crisis. Unemployment's coming down, but it's still 7.6%. More than a third of the people who are unemployed are long-term unemployed, which is a true crisis for those more than 4 million individuals and families caught in this situation. And as you've discussed with this committee in the past, long-term unemployment can have serious consequences, making it harder for people to maintain skills and networks to re-enter the workforce. So my question is, while the economy is recovering, we still have a lot of work to do to get full employment and strong, broad-based growth. With core inflation well below the Fed's target and weak demand suggesting that inflation is unlikely to be a problem anytime soon, isn't it still way too soon to consider any kind of policy tightening?
Well, again, I've distinguished between changing the mix of our two tools and the overall thrust of monetary policy. And I agree with you that with inflation below target and with unemployment still quite high, and by some measures with unemployment in some ways being even too optimistic a measure of the state of the labor market, given some of the other statistics that you cited, that both sides of our statutory mandate are suggesting that we need to maintain a highly accommodative monetary policy for the foreseeable future, and that's what we intend to do. But I think that we will be able to maintain that high level of accommodation ultimately through rate policy and by holding a very large balance sheet. But in making that transition to a different stage of this process, we again are intending to keep policy highly accommodative.
Let me just follow up on that. As the Reserve has engaged in measures to strengthen our economy, some critics have argued that any growth that results might somehow be artificial, or that low interest rates and cheaper credit might lead to financial instability or asset bubbles if investors make riskier investment in order to, quote, reach for the yield. In the current environment, though, isn't weak demand the greater concern? If consumers are pulling back on their spending because of high debt burdens and underwater mortgages from the financial crisis, and businesses are holding off on investing because of the weaker consumer demand, doesn't that change the relative costs, benefits, and risks of different monetary policy actions?
Yes, it can. On the first point about artificial growth, during the 30s there was this view called the liquidationist view, which held that recessions and depressions were healthy. They purged the evils out of the system. I don't think we accept that point of view anymore. We think our economy is producing below its potential, and what monetary policy is trying to do is help the economy return to its potential, and that would be real and sustainable growth that we could achieve. On financial stability, there are, obviously given recent experience, we want to be very careful that we understand what's going on and pay close attention to these issues. The relationship between monetary policy and financial stability is a complicated one. On the one hand, very low rates for a sustained period can lead to reach for yield and other risky behavior. We are trying to address that primarily through regulation, through oversight, through monitoring, and that's our first line of defense, certainly, for dealing with those sorts of issues. But you correctly point out that it isn't a simple relationship because, of course, a weak economy also is bad for financial stability because it means weaker credit quality, less lending opportunities, more defaults and delinquencies. So again, our strategy is to try to focus on inflation and unemployment using monetary policy but to pay close attention to any developments in the financial stability sphere and use the regulatory and supervisory tools we have as the first line of defense in that case.
I appreciate that. And the reason I ask those specific questions is because there's been a great deal written and said about expansionary austerity. And as I look at what is happening in Europe, I'm not sure that all the measures taken under that guise produce either the economic results that we'd like to see and certainly the consequential human results that we have seen in Europe. And I don't want us making those mistakes here. Thank you, Mr. Chairman.
Senator Corker.
Thank you, Mr. Chairman. And Mr. Chairman, thank you for being here. We were just talking, these second day of these Humphrey Hawkins meetings is about like drinking day-old coffee and maybe even worse, accompanied by a stale donut. But it's certainly, I'm here today. I don't really have any questions. I read your testimony yesterday, but really to thank you for your service. I know we've had our differences on some issues, but I really do especially appreciate the way you handled the crisis. I think that our country was under extreme duress. I don't know how many people could have handled that crisis and the complexities that came with it in the way that you did. So I want to thank you for that.
Thank you.
Obviously, we've had discussions both publicly and privately about some of the quantitative easing, and I know we had differences. But I would wonder, I know that, you know, there's a whole industry of folks out there who watch every word that you say, and people are right now doing calculations as to whether to buy this instrument or that, and I know that you have to be very cautious in what you say sometimes, but this is a little bit of a step back. I guess, you know, some of the concerns that I've had, and I think members on this side of the dais, have just been the hyperactivity of the Fed, and the Fed almost acting as an enabler for Congress, which has had very bad behavior for a long time. Our inability to do the things fiscally and in other ways that would stimulate our economy, and I think you're well aware of those. You do a pretty decent job of staying away from that, although sometimes I wish you'd weigh in more. But I do wonder if you have any possibly parting comments. I don't know what your future is, and none of us do at this moment. But I wonder if you have any comments about that, about any concerns about over time because of the hyperactivity that the Fed has been engaged in, and in some ways because Congress has been so feckless in living up to its responsibilities and dealing with the issues that we have to deal with. If that is of any concern to you, and is there any similarities, if you will, to a person who knows that they need to do certain things to eat right and exercise, and instead, you know, relying on the Fed for amphetamines and other kinds of activities to get in a place that the economy needs to be in our nation and candidly the world. But again, as you potentially contemplate those, I do want to again thank you for your service. Thank you for your friendship, and whatever happens, I wish you well.
Thank you very much for those comments, Senator. On hyperactivity, I think what we learned during the crisis was that we didn't have the right tools. You know, we didn't have a way to address a failing investment bank that wouldn't create a huge amount of bad effects in financial markets. We didn't have appropriate oversight of the shadow banking system. There are a lot of weaknesses in our oversight, our regulatory system, and our response tools to the crisis, and that's why it sometimes seemed frenetic, because the Fed was trying to improvise in many cases. And I think we've made some progress in setting up a more orderly framework for both strengthening our financial system, monitoring the system, and responding in case of another emergency. So I hope that that's the case. It is true that monetary policy, I think, has carried an awful lot of the burden for this recovery, and you know, we're more than happy to share that burden more equally with fiscal policy and other policymakers. But I recognize it's been a difficult time politically for people to come to agreement on some very important issues. And I don't think, you mentioned the enabler idea, I don't think it's my place or the Federal Reserve's place to try to force Congress to come to any particular outcome. I mean, it's Congress is ultimately who is responsible, and our role is to take what Congress does as given and to try to figure out how best to meet our mandate given Congress's actions. I don't think we should be in a position of trying to threaten Congress with higher interest rates or something like that.
Yeah, and I know that's not your place, and I know that you operate under our mandates. I would think, though, that most people would ration that, the fact that the Fed is there and does have to do what it does, in some ways acts as a cover for us in our inability to act responsibly. I mean, I think that goes without saying, doesn't it?
Well, I think, as you can see, that our acting alone is not producing the kind of results we all would like. I mean, growth is going in the right direction, unemployment is going in the right direction, but it's still a very slow process. And as I've said many times, monetary policy is not a panacea, so there's still plenty of room for Congress to address some of these problems that Senator Menendez and others referred to.
Thank you.
Thank you.
Senator Reid.
Well, thank you very much, Mr. Chairman, and let me join Senator Corker, Mr. Chairman, and commend you and thank you for your service to the nation. I witnessed your innovative, improvisational, and very thoughtful approach to problems that were potentially devastating to the economy. I think through your service, we avoided a much worse situation, and I thank you for that. One of the things reflecting back, though, is, it's the 20/20 hindsight. There were a few governors of the Fed who were talking about a housing bubble as the next sort of great crisis, but it didn't get the traction. Perhaps not identically, but in a similar vein, you've got some of your colleagues are now talking about the huge growing student debt that could have macroeconomic effects, slowing down home purchases, slowing down sort of what we assume was the normal course, that by your late 20s you buy the home, you settle down, et cetera. And also, I think, in a way, underscoring another huge problem in the economy, which is the inequality, growing inequality of income. Our sort of American solution to inequality is education. That's the engine. We have reports, for example, from Georgetown University that there's already a 5 million projected gap between jobs available that will be there and skills available to fill them. And yet, as we increase the cost of borrowing, and all of the proposals that we're talking about currently do increase the cost, that I think will cut down on opportunities for a lot of people. So can you comment, one, on this potential sort of crisis in student debt, its macroeconomic effects, and whether, if we don't provide some type of support, both directly and also refinancing support, that this could be the next big problem we face?
Well, first, it should be acknowledged that the ability to borrow to build your own human capital to get an education is an extremely important and good thing. There was a time when poor student, no matter how qualified, was unable to finance an education, and the fact that we now can do that is very good for our economy as well as for individuals. The amount of student debt is large. It's over $1 trillion at this point. I think that it is not particularly likely to cause any sharp instability of the sort we saw in the last few years. It has a couple of consequences. One, of course, is it represents a potential fiscal risk for the U.S. government to the extent that some of it is not repaid. Secondly, to the extent that there are people who have taken out a lot of debt and the economy is not serving them well, they're not finding opportunities, then obviously over time, this is not something that is a big issue at any given moment, but over a number of years they will not be able to buy the home and do other things that they otherwise would be able to because they're paying off the debt. So I think the answer to it is, first, of course, to have a strong economy that provides job opportunities, and that's something we're trying to do, and I'm sure you're trying to do as well. But the other is, I think we need to make sure that students are better informed about the market, labor market, and their opportunities and what different options they have. We know of cases, some of the private sector universities, online universities and so on, which don't have very good graduation or placement rates. People are still borrowing to take those courses. I think if there was better counseling, better information, that would certainly be an important step. But I don't want us to step back from doing everything we can to give young people a chance to get whatever skills that are appropriate.
Let me just, the broader question was just this, your comment, this growing documented inequality in income in the United States. Does it pose both economic and social risks to the country? And how do we deal with it other than through education and in many different ways?
It's a very, very tough problem. It's not restricted to the United States. It's a global phenomenon. It's been going on for a very long time. There are a number of factors behind it. I think, though, that one of the most important is that the new technologies we're seeing are what's called skill biased, that they favor the most skilled workers, and they reduce opportunities for people of medium or low skills, particularly in competition with the global labor force. So I don't have an easy answer. I do think that, related to your question about student debt, I think that focused skill enhancement, people, instead of, not everybody should necessarily be doing a 4-year BA. Some people would be better off working specifically towards a job in industry where there's understanding in advance that this is what's needed, this is the opening. Community college prepares those kinds of courses. So more focused job-oriented training for some students who are interested in that might be helpful. But this is a long-term trend, and I don't have an easy solution for it.
Thank you, Mr. Chairman.
Senator Toomey.
Thank you, Mr. Chairman, and I too want to thank Chairman Bernanke, not just for being with us today, but also for his years of service. And we've had our disagreements over the years, but not without, on my part, a great deal of respect for the way you've approached this work and the work that you've done. I have a few questions I hope we'd be able to mow through. One has to do with the efficacy of the quantitative easing. And more specifically, there's a number of very thoughtful folks have done analyses that suggest that the benefits of the quantitative easing we've had might be quite modest. And specifically, I think the suggestion has been that conventional understanding of the transmission mechanism of the increase in household net worth to consumer spending would suggest a very modest increase to GDP that's resulted from the pretty significant increase recently in household net worth, even if you attributed all of that increase to the Fed, which is itself a questionable premise. And then your own previous testimony, I think it was at Joint Economic to a question that I asked, if I understood you correctly, you acknowledged that the nature of the impact that monetary policy tends to have on economic growth might be more a matter of timing rather than a net increase. So accommodative policy can accelerate, can move forward economic activity, might not increase economic activity in total. So I guess what I'm saying is if the magnitude of the benefit has been very modest, and at that it might be just a shift in timing anyway, that would suggest pretty modest benefits, and yet the cost and the risk keep mounting. In my view, the risks of asset bubbles, mispricing assets, the risks of whether or not we'll have an orderly exit. So I guess my question would be, number one, how do you quantify the benefits that have been occurring, and especially near-term marginal benefits going forward? And can you and do you systematically attempt to quantify the risks of what you've done?
Yes, that's a very good question. There's a very large literature, academic and within central banks, trying to figure out how big the effects are of quantitative easing, and it's quite difficult to know for sure. But the preponderance of the evidence is that while this is not as powerful a tool as ordinary monetary policy, rate policy, that it does have meaningful impact on jobs and on the economy, and in particular, since 2008, where we've had no ability to move short-term rates, and we've had some periods where we became, somewhat more concerned about deflation. We think that QE has provided an important boost at critical times to help the economy continue to move forward. So I don't want to overstate it, and again, there's a lot of uncertainty, but there's a lot of work on this, and the preponderance of the work suggests that the effects, while not huge, are quite meaningful. Also, in terms of timing, it's true that no monetary policy can do very much about the long-term growth potential of the economy. But in a situation where we're well below that potential, if we can get back to that potential more quickly, that is a net gain that is enjoyed by the economy. In terms of costs and risks, we have I've identified in speeches and other places some of these risks, and we, as I said, it's in our statement that we look at this carefully. I think the one that we have paid the most attention to is financial stability, and we have tried to greatly increase our vigilance, our monitoring, our use of supervisory tools and the like. And as Senator Menendez actually pointed out, though, there's also risks on both sides because, of course, if the economy does very poorly, then that also creates risks to financial stability because of the effect on default, delinquency, and so on. So let me just acknowledge that this is an issue that is an important one. We believe the first line of defense should be monitoring, supervision, regulation, and other similar tools. But we do take into account, these costs and risks when we debate our monetary policy.
Do you attempt to quantify it, or is it all subjective?
We try to quantify it. It's very difficult, of course, to know exactly what the size of the risk is, but what we do is that we do a lot of work, both qualitative and quantitative, trying to measure, for example, we might be looking at covenants on loans and whether or not those covenants are becoming less restrictive, which is suggestive of more or poorer underwriting, for example. So we monitor those kinds of things and we report those to the FOMC at essentially every meeting so they can understand where there may be sectors where financial risks are building and try to gauge those risks.
All right. Thank you. I have other questions, but I see my time has expired. Thanks, Mr. Chairman.
Senator Schumer.
Thank you, Mr. Chairman. I want to thank you as well, Chairman Bernanke, as you endure your second marathon in 2 days, and echo the views of many of my colleagues in the House and Senate who thank you for your service during such a critical period. Your quiet but strong leadership has been instrumental in keeping our economy from falling into an abyss and repeating the devastation of a Great Depression, and we are now, because of your leadership, on the path towards turning that economy around. My view is that 2014 and 2015 will be stronger economically than our present time, and that will be in large part because of the building blocks that you put into place, even if you're no longer chairman of the Fed, not prejudging anything, of course. So here are my questions. You've been as clear as I think you can be that the timing and pace of any tapering, these are monetary, timing and tapering of your asset purchases will be dependent on economic and financial conditions. That's logical. In June, the committee projected the economic growth would pick up in coming quarters, but since then, economic data has been mixed. We've had decent job numbers, but many signs of weakening growth. We found out that the baseline for your June outlook was worse than we first thought. First quarter GDP numbers were revised downward. So the economy is worse than you thought in June, but the markets appear to think that you're still set to begin tapering in September. So if the economy didn't change, we're exactly today as it is today on September 18th, would the Fed be announcing a moderation in the pace of its assets? And just one subsidiary question. You've often said that asset purchases will continue until the Fed sees, quote, substantial improvement in the labor market outlook. Does weakening data regarding growth change your outlook with respect to the strength of the labor market? In other words, can labor markets continue to improve in relative growth? So first about September 18th and then about the labor markets.
Well, the June FOMC meeting was only a few weeks ago. There have been some data points since then, and as you say, they've been mixed. So I think it's way too early to make any judgment. We'll be obviously reviewing the data, and what we're looking for is a pickup as the year progresses, because our theory of the case, if you will, is that one of the reasons that the economy has been so slow in the early part of 2013 is because of fiscal factors. It's hard to judge how long those factors will last, but if the economy begins to move beyond that point and fiscal restraint becomes somewhat less pronounced, then we should see, as you suggested yourself, a pickup in growth. And so that's what we'll be looking for. It's too early to...
But the September 18th deadline of beginning tapering is not immutable. You're going to look at the data.
We're going to obviously look at the data. It's a committee decision, and it's going to depend on whether we see the improvement which I described.
Right. And the second question, does the weakening data regarding growth change your outlook with respect to the strength of labor markets?
Yes, so we talked about, we specifically set as a goal an improvement in the outlook for the labor market, as opposed to the labor market per se.
Yep.
And what that means is that we want to see improvement in labor market indicators, but we also want to have a sense that improvement will continue. And of course, for improvement to continue, you need to have a broader based growth. And so of the three conditions which I described, one of them is a pickup in growth, which will be sufficient to provide continued improvement.
You think we still could be on the path to labor markets improving even with this relatively weak growth in terms of outlook?
It's possible. I think, again, it's only been a few weeks since the June meeting, and I don't think we have new data.
Okay, my first question was about the tapering. My second is when you might end asset purchases altogether. The minutes of your last meeting said that, quote, about half of the participants indicated it would be likely that it likely would be appropriate to end asset purchases late this year. Yet you yourself said in guidance that was approved by the committee, based on current projections, you expect asset purchases to end sometime in the middle of next year, when you currently anticipate unemployment will be down around 7%. That's the level of unemployment, you say, represents the amount of improvement that would warrant a moderation in Fed policy. Do those other members have a different definition of substantial improvement in the labor market? There seems to be some disparity between the other members and you, and if you're not there come next year, there's a worry there. Or a different view of the likely path of the labor market? Do they think unemployment will be 7% this year, or do they have different assessments about the relative cost and benefit of QE?
Well, there are diverse views, obviously, on this program. And in particular, people could see an early wind down because they are optimistic about the economy, or because they don't think that QE is very effective. I mean, a lot of different reasons why you might have that view. Let me just assure you that we have a very careful discussion at the meeting. We have what's called a go-round, where every person, including the non-voters, gets to express for several minutes their view on policy, both current and prospective. And the general scenario, which I described in my press conference, is broadly supported by people on the committee, and including both voters and non-voters.
Good. That's good to hear and gives me a little relief.
Thank you, Mr. Chairman.
Senator Coburn.
Mr. Bernanke, I appreciate the service that you've given our country, and we have nobody to compare you to because we've never been in the situation we were in before. But I think basically you've done some significant work for the average American, and I appreciate it. I have a couple of questions in terms of your balance with your mandate, both in terms of inflation and employment and growth. One of the things that concerns me is since 1980, we've changed the way we measure inflation 20 times. And if you used the same measure of inflation that we had in 1980, our inflation rate would be over 8% right now. And the other thing that concerns me is median family income in real dollars is the same as it was in 1989. So if I had a criticism of anything you've done in the last few years, it would really go along and align more with Senator Corker's thoughts, is we have let you down. The kindergarten of Congress has let you down by not
doing the things to create the confidence, to create the certainty in the business community that will allow the significant capital that's sitting on the sidelines to be invested, which would create some of the growth that you're hoping to do. So for that, I apologize. But would you care to comment, since in your testimony inflation's under control, but the average American over the last 10 years has seen significant inflation, and in the last few years has seen significant inflation in the things that really matter. And let me talk about it. Cost of an education, transportation, electricity, rents, food. Plus, out of what we've done, not intentionally, we've gotten a commodity bubble in many areas in terms of raw commodity. Would you comment on both the changing metrics that we use for inflation, as well as maybe what we could have done looking backwards that might have accentuated and augmented what you've done?
Well, on inflation, the inflation statistics are calculated by the Bureau of Labor Statistics, as you know, which is made up of highly qualified professional economists. There's no partisan influence. And their efforts are always to try to make the inflation numbers better, make them more accurate. And that's my sense of what's been happening there in terms of changes. There was a bipartisan commission on inflation measurement a few years ago, which concluded that the official inflation numbers overstated, not understated inflation. And so some of the changes they recommended have been included. So there's a distinction between prices being high and prices being rising. If it's true that gas prices and food prices, all these prices relative to people's wages aren't going up much.
That's right. So the cost of living is going up.
No, it isn't going up. It's high. It's not going up. In other words, real wages
are going down.
Real wages have been going down because even though inflation is very low, wages have been growing slower than inflation. So
discretionary income has decreased, so consumer spending is not rising at the rate at which you would like to see it.
That's true, but that's not an issue of inflation. That's an issue of real living standards, and it has to do with the productivity of the economy and the distribution of income. And the Fed really can't do a whole lot about that. So I guess I would just respectfully disagree that inflation is badly undermeasured. I think their professionals are doing as good a job as they can to measure inflation. And if you look at a lot of prices, and including rents, food, gasoline, and so on, again, while they may be high, they're not much different from they were a year ago. And that's what inflation is about. It's a rate of change over time. In terms of what Congress could do, I mean, I think, you know, I can only go so far in recommending, but I do think that an attempt to focus the budget consolidation efforts more on the longer term,
I agree,
would have been a more productive way, rather than putting so much of the tax increases and spending cuts in a front-loaded way, would have been more helpful. That would have been one suggestion.
So if, in fact, Congress had behaved appropriately and helped create a certainty in the long term, especially with our entitlement programs, but also in terms of some of the ways, the effectiveness of some of the things you've done with monetary policy might have been greater.
Certainly.
Thank you.
Senator Brown.
Thank you, Mr. Chairman. Chairman Bernanke, thank you for your service, as others have done, and we all mean that. And thank you for the new rules on capital standards that you have issued with OCC and FDIC. I urge you to hold fast on them when the mega banks fight to weaken those standards, and I hope that you will do that. Some financial institutions argue, as we have discussed, that we should not get out ahead of Europe in our financial regulation. On Monday, Governor Tarullo said, and I want to quote at some length, "I think it's very dangerous that some have tried to characterize Basel agreements as the ceiling, not the floor. So for us in the United States, those of us who are charged with financial stability of the United States need to make the judgment as to what levels of capital will most ensure financial stability in the country without unduly affecting the flow of credit." Even since the publication of our proposed reg, I've had calls from my counterparts around the world, Chairman Tarullo says. That's really interesting, they're saying. Tell me the reasoning on this, how you're thinking about it. Explain to me more why you think 3% is inadequate, end quote. When I hear Governor Tarullo saying is that we should do what we think is best for our financial stability, and if we lead by example, the rest of the world will follow. Do you agree with Governor Tarullo?
I certainly agree with the first part, which is that Basel III is a floor. It's not a ceiling. It's really a least common denominator because these agreements are made essentially by unanimous consensus. And therefore, if there are a few countries that are very resistant for whatever reason, you know, that makes it tougher to get the higher standard. So we view them as a floor. We were prepared to do whatever additional steps are needed in order to make our financial system safe. I don't know whether all countries will follow us, but there are other countries, Switzerland comes to mind, UK, that have thought hard about this and have made taken additional steps to strengthen their banking systems. And we do have a leadership position, and I hope that will happen. But I don't think it'll be universal. I think that you'll see different responses from different countries.
But the most important countries with financial systems will follow, as Governor Tarullo suggests?
I don't know whether they'll follow the exact same things, but they've all got the key financial centers, which recognize how important banks are to their economy, but also the fact that in some cases the banks are bigger than their economy, recognize that it's very important to have stability, and they have been particularly willing to consider additional steps.
So we should not shrink from doing the right thing for stability of our country because some mega banks say that we will be an outlier and other countries won't follow. Agree with that?
Well, the other countries may or may not follow. Some will. But whether they do or not, I do agree that we should do whatever we need to do to make sure that the U.S. financial system is safe.
Thank you. Let me ask another question. It's bank earnings season again, as you know, and it's no surprise that mega banks are doing quite well, yet they continue to claim that new regulations, impending regulations are killing them. Tuesday's Financial Times said, here's the problem. Banks have spent a lot of time, energy, and money warning of the potential ill effects of ramping up regulation, but since the crisis, international regulators have kept demanding more capital, including a surcharge for the bigger banks, as you said. Lenders have doubled their capital levels as a result, hitting the new Basel III target 6 years early in some case, and yet, Financial Times asks, where are the ill effects? The best of them continue to set new profit records with every earnings season. Warnings of calamity look more and more hollow. Unquote. The debate about the Fed's new proposed supplementary leverage ratio reminds me that when we think about costs, we as policymakers, regulators, and elected officials, when we think about costs and benefits, industry wants us only to think about cost to them. Steel companies dump waste into our rivers, and then they argue that it will be costly to clean it up. It's a higher human cost to the miners and the children who get sick from the pollution. It passes more health care costs onto our society, clearly, as they fail to internalize those costs. Those who believe in a society with rules understand that auto safety might cost car companies a little bit more for airbags and seat belts and other safety features, but these protections save lives. The same with financial rules. They might cost bank executives a little bit more in smaller bonuses and maybe even in dividends, but they'll help prevent a repeat of what we had 5 years ago, where the costs obviously were shifted to the broad public in retirement savings, in lost jobs, in every way imaginable, and certainly people's lost homes. If these are the costs of a safer financial system, aren't they worth it?
The crisis was an enormous waste of resources, and its unsafe practices by large financial institutions pose a risk not just to themselves but to the rest of society. And in setting policy, we should look at the social cost and not just the cost to the firms, and that's what we're attempting to do.
And if it means the bonuses are a little smaller and that dividends are a little less and the earnings reports of the banks aren't quite up to what they were this quarter, which was pretty lucrative quarter for them, that's a price we should pay as a society?
From a cost point of view, I think what we should be looking at is whether there's any effect on credit availability, things of that sort that affect our economy more broadly. But I certainly agree that, again, given the enormous cost of the crisis, that strong measures to prevent a repeat are obviously well justified on a cost-benefit basis.
Are you concerned that these higher capital standards will result in less credit available?
I don't think so. No, I'm not concerned about it. We've done some analysis of that, and there's not much evidence that
So
would
there's
be a
not
problem.
really much downside if you said that higher capital, that you said that the biggest potential problem with rules is, does it mean less credit available? If it doesn't mean less credit available, there's no real downside for strong capital standards.
The only downside I can think of is that credit flows may find, if banks are finding themselves finding it very costly to make loans, then credit may start flowing through other less regulated channels, and those have to be monitored.
But you're not implying at all that we're there yet, even close to that situation with capital standards.
No, we're not there yet, but we have to watch the shadow banking system and other parts of the system to make sure that risks are not being offloaded into other parts of the financial system.
Okay, thank you, and Mr. Chairman, thank you for generosity of time. And
Senator Heller.
Thank you, Mr. Chairman, and I certainly appreciate the questioning of Senator Brown and Chairman Bernanke. Thank you for being here and taking time, because I was pleased to hear that you said Basel III is the floor. And the question, I think you answered the question. I was going to ask you to give me some insight why we came to Basel III as opposed to a former FDIC chair who wants that percentage to be closer to 8%. We have legislation around here that wants it as high as 15%. So I was looking for some insight as to where we came to those Basel III capital rates, and it appears the answer may be risk unless you have more to add to it.
Well, we have a program for building up capital, and I described part of it, which was Basel III itself, which triples the amount of high-quality capital, then the surcharges, then the higher leverage ratio, and in addition, we're looking at things like capital charges for wholesale funding, if firms rely on less reliable wholesale funding, and discussed also the possibility of requiring large firms to have unsecured senior debt in their capital structure, which could also provide some buffer in the event that the firm fails. So we are, in a variety of ways, trying to build up the buffer that these large firms have, yes.
Let me change the topic real quick here on to housing. Wall Street Journal recently had an article on the city of Las Vegas and the difficulty of moving homes. We've had 300,000 people in Las Vegas receive foreclosure notices. Not be foreclosed on, but receive notices. Over 50% of the homes are underwater. And I know you've played an important role in trying to reverse this situation. What are we doing wrong, and what can we do? What can we do as a Congress to help move and change the situation we have not only in Nevada, but Arizona, Florida, and some of these other states?
Mm-hmm. Well, as I was saying earlier, I think that from Congress's point of view, that getting the mortgage finance system working better in terms of reforming Fannie and Freddie and helping to clarify the rules. Some of that is on us as regulators to do that, so that there's greater access to credit and more people can buy homes, because ultimately the solution is to find a demand side for the market, so that the demand for homes will support prices and help us get out of this housing problem we have.
Yeah, I wasn't here earlier in the discussion of the reforms for Fannie and Freddie. I've signed on to the bill here in the Senate side. I know the House rolled out theirs yesterday. Mm-hmm. Do you have a preference?
I think it's very important that the Congress move forward on this, and I think it's time to do that.
Your insight on a secondary market or government involvement in mortgage securities?
I think a key issue is going to be not so much making mortgages cheaper, but rather making sure that there is some kind of backstop or protection for situations where the financial markets are in distress, like they were recently. And then the question is, the government is one way to do that. There may be other ways to do that. But if the government is involved, I think it would be very important to make sure, first of all, that the government is appropriately compensated for whatever insurance or backing it provides. And secondly, that firms that are securitizing hold enough capital, again, to protect the taxpayer from losses. If that's done, I think that would be, those would be very helpful if you come to a solution that involves a government role.
Let me talk about one other topic, because I don't have a lot of time. Sorry to jump around so much, but gold prices. We had gold prices almost $2,000 an ounce It's dropped about $600 an ounce, trading, I think, today around $12.75, somewhere around there. Do you have any insight on why this volatility, what quantitative easing would have, what long-term impact it will have as you ratchet back?
The gold is an unusual asset. It's an asset that people hold as sort of disaster insurance. They want, they feel if things go really badly wrong, at least they will, they'll have some gold in their portfolio.
Is that an accurate?
Sorry?
Is that an accurate feeling?
It's not all that accurate. I mean, for example, a lot of people hold gold as an inflation hedge, but the movements of gold prices don't predict inflation very well, actually. But anyway, the perception is that by holding gold, you have a hard asset that you'll be protected. It will protect you in case of some kind of major problem. And I suppose that one reason that gold prices are lower is that people are less concerned about extreme outcomes, either particularly negative outcomes, and therefore they feel less need for whatever protection gold affords.
So you believe it's an indication of perhaps psychologically the direction of the economy for investors?
I think psychologically, the gold price going down is not necessarily a bad thing from that perspective. It suggests people have somewhat more confidence and are less concerned about really bad outcomes. But let me just end by saying that nobody really understands gold prices, and I don't pretend to really understand them either.
Thank you. Mr. Chairman, thank you very much.
Senator Warren.
Thank you, Mr. Chairman. And Chairman Bernanke, thank you for all your service during very hard times. I still want to ask about some other risks to the economy. The biggest banks in the country have reported huge profits over the last couple of years. But just this week, they reported some staggering numbers. Wells Fargo's profits jumped 19% from last year. J.P. Morgan Chase profits jumped 31%, and Citigroup's profits jumped 42%. Now, some reports have indicated that a big part of those profits have come from the bank's trading activity. In other words, not from boring banking, but from trading on Wall Street and elsewhere. So are you concerned that these biggest banks are loading up on big risks again, or is there another explanation for this spike in profits?
Well, let me just say that we are quite aware of these portfolios, and we are addressing them in at least two ways, or more than two, really. But one of them is that we have just finalized new capital requirements that banks have to hold against these assets for sale, these securities, which should provide protection. We have done stress tests where we assume that a December 2008 type of financial shock hits, and so there's a huge drop in asset values. And we have stress tested the banks, again, to see do they have enough capital to cover, protect themselves against big losses in their securities books. The other thing is, of course, is that we are working hard with our colleagues to put the Volcker rule into place, and that will restrict proprietary trading.
So let me just say, though, Mr. Chairman, the question I'm trying to ask about is whether this indicates they're loading up on risk. And I very much appreciate that what you're telling me about are the ways we're trying to regulate the risk when the banks take it on. Maybe I could ask this slightly differently. And that is, yesterday, Secretary of Treasury Jack Lew said, and I want to get the quote right, if we get to the end of this year and we cannot, with an honest, straight face, say that we have ended too big to fail, we're going to have to look at other options. Do you agree with the Secretary of the Treasury?
I don't know about the timing. Maybe I take another year from now, but I've said to you in an earlier hearing that there is a strategy. Dodd-Frank lays out a strategy. Basel III provides additional support through capital, et cetera. But if those things do not make us comfortable about the status of these largest firms, yes, I do think additional steps would be appropriate.
Then we need to look at other steps. As you know, I've introduced, along with Senator McCain, Senator Cantwell, Senator King, a Glass-Steagall bill, another tool in the toolbox to deal with too big to fail. But I think at least now we've got some time on this. The Secretary of the Treasury says by the end of the year, you say maybe a year longer, but we've got to keep this one under examination. Fair enough?
Yes, I think we obviously want to look at all tools. I think that there's probably more scope for capital.
Yeah.
If we're not comfortable with the status of these firms.
Good, and fair enough on that. I want to ask you, as you know, the Federal Reserve and the OCC announced last January that they were stopping their investigation into the systemic foreclosure fraud and that you'd reached a settlement with the largest mortgage servicers in the country. And just last week, the OCC announced that 52,048 people just in Massachusetts received checks so far under this settlement. And it was an aggregate total of $41 million in compensation, or about $800 a family. Now, that's $800 a family in a state, Massachusetts, where the median home income is $324,500. I'll do the math for you. That's about 0.2% of the purchase price of the average home in the Commonwealth of Massachusetts. Now, it's my job to look out for families in Massachusetts, including helping them get basic information about whether settlements made on their behalf by the government are fair. And to do that, 6 months ago, I started asking for basic documents about the investigation and to see what the foreclosure fraud investigation had uncovered. How many people had lost their chance to save their home, just really how bad the damage was. So far, the Fed and the OCC have disclosed very little of what I've asked for. So the question I have is how the people I represent in Massachusetts who believe they were cheated, or the 4 million people who receive checks around the country, how they know that the payments they're receiving are fair if the Fed and the OCC won't disclose details about what they uncovered in the investigation.
Well, as you know, we stopped the investigation well before all 4.2 million borrowers were analyzed, so we don't have that information for everybody, but we do have it for some folks, and we are looking to see if we can find a way to get that information to the individuals whose files were evaluated by the independent consultants.
Good. Yeah. So we're talking about getting that information to them and releasing more information about what you did find in the aggregate?
Yes, we hope to have a report on this whole thing within the next couple of months.
Good.
That will lay out basically all the information we have. Some of the things that you've requested, frankly, we just didn't collect or, whatever, but we will try to provide as much transparency as we can.
I would be very grateful for that, Mr. Chairman. You know my concerns in this area generally, that if the regulators are not aggressive enough, if they don't require admission of guilt, if they never take large financial institutions to trial, then the resulting settlements are too weak. And so I know you appreciate that a slap on the wrist is not enough. And if the OCC and the Fed are confident that these are good settlements, I think it helps everyone if the information's out there. So thank you, Mr. Chairman. I appreciate it.
I'd like to add that, of course, the people who receive checks have not yielded their legal rights, and they could pursue this further if they wish.
Yes, and I hope that by revealing this information, they will be able to better evaluate whether or not that's appropriate for them. Thank you.
Senator Crapo has a brief statement to make.
Yes, thank you, Mr. Chairman. I have a number of additional questions, but we're coming up against a vote right away. So, Chairman Bernanke, if it's okay with you and with the Chairman, I will submit these questions to you and ask you to respond later. The questions that I have, among others, are some further inquiries about the short-term interest rate policy at the bank, the actions right now at the FSOC, the Financial Stability Oversight Council, in particular in relationship to non-bank systemically important financial institutions. And as you might guess, on GSE reform, I would love to get some further information from your perspective on that. But I will submit those questions, Mr. Chairman, in light of the fact that we do have a vote pending. Thank you.
Chairman Bernanke, I want to thank you for your extraordinary service to our nation. And I want to thank you for your testimony. This hearing is adjourned.
We'll see what he does.
It's hilarious. We're watching him, and they're watching on TV.